Hello everyone and welcome to Moementum channel. In this video, we're going to be talking about the topic of cash and whether it's a good decision to set it aside this year and stockpile cash, or you're better off actually putting it into the market to work for you. We're going to talk about that based on some of the articles that I've recently came across. We'll also be talking about and looking into the historical market returns for different asset classes, whether in terms of stock markets, bonds, REITs, and so on, as well as looking closely at different markets, geographical markets, and their historical returns, which can ultimately help clarify why diversification to a broad market, kind of all asset allocation, all geographical exposure could be a good option for many investors. And lastly, I will provide an update into the stock market portfolio that my wife and I have, currently sitting at over $600,000 in market value. Without any further ado, let's get into it. All right, on the screen, I'm sharing with you an article that I have recently come across. I actually came across that through a post that was done on Blossom. A few things that stood out for me from this article entitled ETF Implementation Guide for 2024 are the references to the fact that many investors are actually stockpiling cash heavily, and they're putting cash aside just perhaps in the anticipation of potentially some market downturns, maybe some recession, or possibly, the uncertainty that surrounds them. That said, there is a reference here, you could see here, that they talk about the fact that currently it seems that the major developed markets, central banks have already stopped the rate hikes. We've seen it, like, the rates have actually stayed flat for the past several rounds of the monetary decision making, and there is a good chance that the rates actually are going to start dropping and being cut very soon. According to this article, they are more leaning towards second half of the year, even though many investors are counting on it to be cut even earlier. That said, this is the part that really stood out for me. They're saying that in 2024, sitting in cash risks missing out on bond and equity market returns. And they elaborate on that. They're saying that in the previous 5 hiking cycles since 1990, the Fed paused on average of 10 months between the last hike and its first cuts for the rate cuts. So on average, there was 10 months in between those two points in time. And on average, stock and bond returns have been higher during those pause period than easing periods immediately following the first cut, which suggests that, if you're sitting on the fence, just putting your money in the cash, waiting for the first rate hike to happen, and then only perhaps redeploy your funds, you might be missing out potentially, at least based on the historical average, based on those timelines that we pointed out. And this chart and this actually graph nicely elaborates on that. As you can see, the pauses have paid off even more than the easing periods. So the middle of the chart, this is the rate pause period during the time that we are currently in, and we are most likely at one point are going to lean towards and move towards the rate cut, potentially sometime in 2024. As you see, both equities and bonds, as well as potentially some cash, but mainly if you look at the greatest return has been for equities, drastically outpacing the 6 months before the last hike, as well as the 6 months after the first cut. The same goes for bonds. Of course, equities, no surprise, have been showing the greatest average returns there. The next thing I want to touch on is the historical returns for the market. There's this website that I love. It's called novelinvestor.com. It has a lot of great insights when it comes to data related to historical returns, market returns, different asset classes. This is the page that I'm sharing with you. It's called Historical Returns on Stocks, Bonds, and Countries. As you scroll down, first and foremost, it starts with this table around asset class annual returns from 1926 to current time. And of course, those data points are provided based on the availability of the data. For example, for US large caps, US small caps, international stocks, emerging market stocks, REITs, high grade bonds, and high yield bonds. And if I scroll down, it's provided by each year. It allows you also to download the data and explore it in different formats and do some further analysis there, which I've done. But let me just quickly scroll down all the way to the bottom. This data is available based on these sources that are provided to you, and all the way until the end of 2023. If I hover over it and see the averages, so for example, for US large caps, ever since the data was available, in this case from 1926, as early as 1926, all the way to 2023, the average at the bottom right, you see it's 12%. For US small caps, the average was 11% based on that time periods that they have the data available for. As for international stocks, the average is also at 11%. Emerging markets, look at that. The average is at 14%. Albeit it might be more volatile if you look at it. Like, there are years that minus negative 53%. That year, like 2008, it was the worst in terms of the returns compared to the other kind of asset classes and groups. But on average, it was overall showing better returns since the time that the data was provided from 1988. As for REITs, the average return has been 13%. High grade bonds average return has been 7%, and high yield bonds average return has been 8%. First and foremost, as you saw, over the long enough period of time, equities, stock market has performed better than bond market. That's where there are so many kind of articles and body of research that suggest that, if you're investing for the longer period of time, you probably are better off investing it in the stock market as opposed to like bond market. Now, granted, with bond market, the fluctuations might be less, the volatility of your portfolio might be less, but of course, you're losing out on that potentially higher returns over long enough period of time. Which is why, for me and for my wife, currently, given our age and our comfort level, we are fully invested in stock market, 100% exposure through 3 ETFs, and no exposure to bond market whatsoever. If you noticed, for emerging markets, actually the average return was higher than even US small caps or even US large caps or even international markets. So, but albeit with higher levels of volatility and really maybe massive changes from one year to another. But that's something to be mindful of. And another reason why diversification to these broad market ETFs, such as the one that I've already selected in my portfolio, I think it's a smart decision, at least for me personally, because I'm getting some exposure to emerging markets, some exposure to international market, some exposure to Canadian market as an investor here in Canada, as well as some exposure to US market. Moving on, if I look into the same type of analysis, but this is based on by different countries. And I'm going to quickly show you, it's actually on the same page from Novel Investor. If you scroll down, it is available for international developed markets. They have it from 1970s to current time, as well as they have something for emerging markets countries from 1988 to current. And the list actually extends because you have to scroll right. So that's why I downloaded it and exported to Excel or Google Sheets. You do see for different countries. I'm just going to handpick a few. For example, for Canada, since 1970s to 2023, the average return has been 11%. For Australia, average return has been 12%. For example, for Germany, the average return has been 12%. Similar type of analysis that we've done for emerging markets. Let's just handpick a few countries. For example, for Brazil, the average has been actually 23%. Just insane returns. But you see, there are some years that are insanely high, like 1991, 172%. If you're interested to only look at the more recent data, so let's say if you're interested from 2010, you could easily select that and see what has been the average return. The average return in this case for Brazil has been very poor, actually 0%. It's almost balances itself out. Like there are years that they have incredible returns, like 67%, but there are also years that they have had really poor returns. If you look at the past 5 years, though, just let's say since 2019, the average return has been negative 1%. For China, overall, if you look at it, average return has been 7 years. But if you look at, let's say, the past 5 years, out of curiosity, let's see what comes up since 2019. The average return has been 6% annually. Let's look at India as an example as well. I know there are many investors who are interested in the Indian market. Average return has been 17%, but let's take a look at the past 5 years. If you look at the past 5 years for Indian market since 2019, the average return is actually 23%, which is just incredible. It's really hard to know which market is going to do very well in certain years versus the others, and requires probably extensive research, taking time, and definitely some elements of luck. And that's why I believe investing more broadly through a broad market index fund such as XEQT that I have, I think it's smart for many investors, such as the ones in Canada, like my wife and I, because through that we're getting exposure to all of these different geographies and countries. Now, with that out of the way, I'm going to quickly show you the portfolio that my wife and I have. This is a Google dashboard that I've developed in Looker Studio based on the data for our stock portfolio. Currently sitting at a total of $604,643. Just incredible. Couldn't be any happier than that. The overall gains that we've had in this portfolio based on how much we've deposited into our accounts, as well as how much the total value is, over times since ever since we started investing is showing a gain of 16% cumulatively, and for $83,839.98. Our three holdings include XEQT, which is our largest holding. We have over $500,000, $551,865 in it. We have 19,296 shares of it. XEQT is an all-in-one ETF that gives exposure 100% to stock market. And you can see on the other tab, you can even see, for example, what is the exposure by each countries that are highlighted here. For example, 5% to Japan, 0.36% to South Korea, 0.5% to Taiwan, around 0.5%, close to 0.5%, less than that to Hong Kong, around 1.6% to Australia, New Zealand, US, Canada, Mexico, you name it. Like there are all these different countries that you're getting exposure to and getting invested in through that kind of weightage that are highlighted for you on the screen. Now going back to the first page, our shares of XEQT overall are up by 7.2%. Our next big holdings are shares of VTI, or Vanguard Total Stock Market Index Fund. It gives us exposure to the entire US stock market. And for that, our shares are up by 14%. And lastly, we have shares of VT, or Vanguard Total World Stock Index Fund, which gives us exposure similar to XEQT to the entire stock market. Albeit with VT, it's in US dollars and it has less exposure to Canadian markets, only at about 3%. Whereas with XEQT, you get closer to that 24 to 25% exposure to Canadian market. Slightly higher home bias, but research has also shown that there might be some advantage from a level of volatility, less volatility, as well as like more overall return possibly for the investors. That said, we see that our shares of VT are up by close to 10%. In terms of our overall expected annual dividend income for this portfolio is just shy of $12,000. The focus of this portfolio is not really dividend income and more so focused on our ability to generate growth and have a broad market exposure to the entire world stock market. One of the key realization that I've had as well recently is that I'm trying to possibly make a little bit of a switch and instead of actually paying my mortgage down very aggressively, I would like to still do that to some extent, but I'm trying to lower the amount of prepayments that I'm paying on my mortgage and instead redeploy that and put it in the stock market. We'll see how that pans out. I'll definitely keep you posted, and you might notice that as well, that this portfolio size is hopefully going to grow faster as a result of that switch and change. With that, thank you so much everyone for watching this video until the end. If you'd like to follow my journey of investing and see exactly how I'm doing, what stocks and ETFs I'm buying, and as they happen, follow me on Blossom. It's an amazing community of investors here in Canada and US. You can learn from them as well as join for free. If you are interested, I appreciate if you download it using the referral link. It would really mean a lot to me and definitely can help support my channel. Thank you so much, and I hope to see you all next time on another video here on Moementum Finance YouTube channel. Thank you.